Welcome back to Explain the Charts. Today is April 30th, 2026, and the market landscape is absolutely electric as we head into the final hours of the month. We have seen a whirlwind of activity today following major economic data releases and ongoing geopolitical crises. The Nasdaq Composite and Nasdaq 100 are showing slight gains of roughly 0.2 to 0.3%, but this masks a lot of underlying volatility. A major headline today is the AI earnings bonanza, which has started to polarize investors significantly. While tech giants have been leading the charge, we've seen sharp sell-offs in names like NVIDIA and Microsoft as the market begins to weigh concerns over rising competition. At the same time, we are monitoring the blockade in the Strait of Hormuz, which has pushed oil prices to wartime highs. Economically, the United States core PCE price index came in at 0.3, slightly lower than previous months, but the year-over-year figures remain elevated at 3.5%. Investors are also bracing for the final Federal Reserve meeting under Chair Jerome Powell, adding another layer of uncertainty to the mix. Bond markets are reacting sharply, with the 10-year Treasury yield nearing its 2026 highs, signaling expectations for sticky interest rates. As we look at the QQQ daily chart, we can see how these macro events are manifesting in the price action. The index has been in a sustained recovery phase after a period of intense pressure earlier in the year. Current news cycles suggest that despite the IPO dip in the first quarter, analysts believe a sustained downturn is not yet on the horizon. However, the polarization in tech means we need to be extremely careful with our entry points. Let's jump straight into the candlestick data to see what the trends are telling us. Focusing in on the daily time frame from early April through today, the reversal we've witnessed is nothing short of spectacular. On April 7th, QQQ hit a major local low at $402.39, which seems to have acted as a massive spring for this current rally. This bottom coincided with peak fears regarding Iranian economic pressure and initial AI growth worries. Since that low, we've seen a vertical ascent, with the price moving up over 60% in less than a month. Note the massive green candle on April 9th, where the price jumped 12% in a single session. This surge was likely driven by short covering and a massive reassessment of tech earnings potential. As of April 30th, we are trading at $661.57, very close to the recent highs. We've established a significant resistance zone between $663 and $665. Looking at the volume, it remains robust, which suggests that this trend is being supported by institutional buying despite the news of tech sell-offs. If the market can break and hold above the 665 level, we could see an extension towards $700. However, the RSI on this time frame is likely reaching overbought territory given the sheer velocity of the move. A healthy consolidation here would not be surprising, especially with the sticky inflation data we just received. Support is now clearly defined around the $610 mark, where we saw consolidation earlier in the week. If we see a daily close below 655, it might signal a short-term trend reversal as traders take profits before the Fed transition. The daily trend remains bullish, but the steepness of the curve suggests we are in a blow-off top risk phase. Dropping down to the 1-hour chart, we get a much better view of the intraday structure from the last 2 weeks. Notice the consolidation that occurred between April 14th and April 16th, where the price held steady between $620 and $640. This was a key build-up phase where the market was absorbing the initial wave of tech earnings news. Once the breakout above 640 occurred on April 17th, it became a clear launchpad for the next leg up. We can see several hourly gap-ups that were never fully closed, indicating very strong bullish momentum. The current hourly trend is characterized by higher highs and higher lows, though the slope is beginning to flatten out. This flattening often precedes a period of sideways movement or a potential retracement. The $657 level has acted as a minor support over the last 48 hours. If you're looking to trade this short term, watch the volume at the top of the range. Decreasing volume while the price hits new highs would be a bearish divergence to watch for. The hourly candles on April 29th and April 30th show some long upper wicks, suggesting that sellers are stepping in near the 662 level. This correlates with the AI earnings worries mentioned in the headlines today. Microsoft and Alphabet leading the surge in AI demand is keeping the floor high, but the OpenAI shock news is clearly creating some overhead resistance. Keep an eye on the hourly EMA lines. A crossover here could be the first sign of a deeper pullback. For now, the hourly structure is still holding, but the bulls are starting to look tired. Now, looking at the 15-minute chart for the last 48 hours, we can see the micro-level reaction to the PCE data and earnings. Late yesterday, April 29th, the QQQ saw a sharp dip down to the $656 range. This was quickly bought up, resulting in a strong rally into the close at $666. This V-shaped recovery shows that there is still significant buy the dip mentality in this market. However, early today, April 30th, we've seen the price stabilize and even pull back slightly from those late-night highs. The 15-minute candles are currently showing a narrow range, which usually precedes a large breakout move. The pivot point for the rest of the day appears to be the $660 level. If we trade below 658, we could see a quick slide back to the previous support at 653. Conversely, if we can reclaim the 664 level on the 15-minute chart, the momentum could carry us to new all-time highs. The transaction counts on these smaller candles are still very high, which means the liquidity is there for a major move. The news of the Strait of Hormuz blockade is likely causing some algorithmic selling whenever oil prices spike. You can see these intermittent sharp red candles that coincide with headlines about Iranian economic pressure. Short-term traders should look for a break of this morning's high as a long signal. If the 15-minute trend breaks the sequence of higher lows, it's time to tighten your stops. The intraday volatility is high, so expect some fakeouts near these key levels. To wrap everything up, let's look back at the big picture on the daily chart. In the short term, I am cautiously bullish as long as we hold the $655 level. The likelihood of a move to $675 is about 60%, contingent on a positive earnings reaction from Apple. In the long term, we have a very strong uptrend from the April 7th bottom, but the geopolitical risks are a major wild card. If the Iran conflict escalates or oil stays above wartime highs, the bearish case for a retracement to $610 becomes much more likely. Key price levels to watch: resistance at 665 and 672. Support levels are at 655, 640, and the major floor at 610. Watch for the Fed meeting results and any further updates on the Strait of Hormuz blockade. Earnings from Rivian and SanDisk are also on the horizon and could impact the tech sector further. My unbiased prediction is that we will see some sideways consolidation before the next major leg, with a 70% chance of staying above 640 this week. Keep your eye on Explain the Charts for daily updates as this situation evolves. Trading in these conditions requires discipline and a clear understanding of your risk-to-reward ratio. Always wait for confirmation of a level break before entering a position. This analysis is based on the data available as of April 30th, 2026. Please remember that this is not financial advice. Always perform your own thorough research and consult with a professional advisor before making any investment decisions. The market can be unpredictable, especially with the current geopolitical and economic backdrop. Stay safe, stay informed, and happy trading. We will see you in the next analysis. Goodbye for now.